Too early to tell, but we may have found the floor on inbound TEU bookings into the U.S. The severe 33% decline in bookings since May 20th will lead to significant consequences to an already deteriorating truckload spot market. Unlike past COVID-linked import issues, overwhelming demand more than likely will not be a volume-related saving grace. Now, Chinese ports and providences are reopening, and yes, they have posted 3 months straight of overall economic contraction, as reported by their PMI. However, the U.S. personal savings rate recently hit its lowest point since the Great Recession of 2008. And as reported by the Federal Reserve, U.S. consumer credit increased at a record-breaking $47.3 billion in March and $38.1 billion in April, inflation not adjusted. This, of course, indicating that consumers are blowing through cash and leveraging credit to offset inflationary costs that have outpaced recent wage hikes, at least for some. And where are consumers now spending their hard-earned dollars? Less on goods, as can be seen in the dwindling year-over-year retail sales increases, and more on services, as leisure and hospitality jobs in May increased by 84,000, as retail jobs decreased by 61,000. City tenure volumes increased by 36% year-over-year and 13% month-over-month, as opposed to long haul only being up 17% year-over-year and 3% month-over-month, is continuing to improve compliance as one driver can turn several loads a day, running fewer miles. Some West Coast ports losing market share over the past year to the East Coast, and, as mentioned previously, an overall easing of demand as inventory levels and costs remain on their expansionary crusade, are only helping to define and compound the future of a freight market that is desperately trying to establish some form of equilibrium. The DOE, at the pump, and rack price all hit 52-week highs this week, as diesel at the pump rises to $7.72 a gallon on average, San Francisco topping out the retail high at $7.02 a gallon, while McAllen, Texas is experiencing some of the lowest costs at $5.06 a gallon. FreightWave's National Truckload Index, line haul only, continued its slowdown progress, while the same National Truckload Index, including fuel, has been leveling off since May, a clear indicator that extreme inflationary fuel pressures are supporting spot rates, at least for now. This has been your Bridge Logistics Market Update for the week of June 6th, 2022.